If you've ever looked at your bank account and thought, there's no way I can invest or save with this amount, stop scrolling, because this is the only financial channel that actually disagrees with you. Welcome back, or welcome if you're new to Financial Blueprint Diaries. This channel exists for one reason: to decode the complex world of budgeting, investing, and personal finance in a simple, bite-sized blueprints that actually fit your weekly paycheck. Whether you're a college student surviving on financial aid, or you're working hard but feel like you're getting nowhere, this is your space. We don't judge your spending, we just optimize it. We turn scarcity into strategy weekly. Today, I will be answering the question, is dividend investing worth it for students? And by the end of this video, you're going to have a clear action plan. If that sounds like the kind of finance you actually want to learn, hit that subscribe button. It's completely free to build your future with me weekly. Let's build this blueprint together. Let's start with the basics, because I know not everyone here is a finance major. A dividend is simply a payment that a company makes to its shareholders, a portion of its profits distributed to the people who own the stock. Think of it like this. When you own shares in a company, you're a part owner. And when that company makes money, they share some of those profits with you. Now, not all companies pay dividends. The ones that do tend to be more established businesses with stable cash flows. Think Coca-Cola, Microsoft, Johnson & Johnson. These are companies that have been around for decades, have reliable revenue, and choose to reward their shareholders with regular cash payments. Dividends are typically paid quarterly, and they're expressed as a dividend yield, which is just the annual dividend divided by the stock price. For example, if a stock is worth $100 and pays $3 in dividends per year, that's a 3% yield. So dividend investing simply means buying stocks that pay these regular cash distributions. Instead of hoping the stock price goes up so you can sell for a profit, you're getting paid just for holding the stock. Sounds pretty great, right? Well, let's dig deeper. Here's the thing. For years, dividend investing was seen as something only retirees cared about, a strategy for people who wanted steady income, not fast growth. But that perception is rapidly changing. In 2025, a growing number of young investors from their early 20s to mid-30s are building portfolios centered around dividend-paying stocks and ETFs. And there's a reason for that. Reason number one, the psychology of seeing progress. Here's an underrated truth. People stick with what they can see working. When you invest in growth-only stocks, all your gains are invisible until you sell. But when you invest in dividends, and especially when you reinvest them, you see your share count rise every month or quarter. It's not just money, it's progress. That visual feedback loop reinforces patience. Reason number two, compounding is magic, especially when you're young. Jim Cramer, the host of CNBC's Mad Money, calls dividend reinvestment magic. He says if you keep them in your fund by reinvesting them, you end up with just a huge amount of stock that you never thought you'd have. The key is time. The longer you allow dividends to reinvest, the faster your portfolio grows. Small investments made early can compound into significant sums, thanks to the power of reinvestment. Here's the math. If you invest just $100 a month into dividend stocks with a 4% yield and reinvest all dividends, after 30 years, you could have over $65,000, with nearly $20,000 of that coming purely from reinvested dividends. That's your money making more money. Reason number three, it builds the habit early. As a student, you have something that older investors would kill for: time. Even small amounts invested now can grow into something substantial decades later. One student shared how they 10x'd their dividend income by simply investing aggressively within their means, saving wherever possible, and reinvesting every single dividend payout. You don't need to be rich to invest. You just need to stay consistent. Reason number four, dividend stocks tend to be less volatile. Dividend-paying companies are often mature and financially stable, as they must generate consistent cash flows to meet payment obligations. They've historically shown lower volatility than some non-dividend paying growth stocks. For a student with limited capital, that stability can be reassuring. Okay, let's be real. I promise you the real answer, and the real answer is, it depends. Dividend investing has some serious downsides that you need to understand before putting your hard-earned money into it. Con number one, you're missing out on growth. Younger investors typically lean toward growth stocks because they have time to ride out volatility and benefit from long-term compounding. Growth stocks think tech companies like Nvidia or AI startups can deliver returns that are orders of magnitude beyond what a blue-chip dividend stock could ever provide. Dividend-paying companies are usually past their high-growth phase. They're mature, stable, and slow. While a dividend stock might give you 8 to 10% total returns per year, a growth stock could potentially give you 20% or more. Over decades, that difference is massive. Con number 2, dividends are not guaranteed. A company's ability to pay dividends can be influenced by profitability, debt levels, future investment plans, and wider economic conditions. When times get tough, companies cut dividends. And when they do, the stock price often drops sharply. Just because a company paid dividends last year doesn't mean they'll pay them this year. As a student with limited funds, a dividend cut could be devastating. Con number 3, yield traps are real. A yield trap is a stock that lures investors with a very high yield, but the yield is high only because the stock price has crashed. Investors who chase the yield can get hit with a double whammy: a dividend cut and a sharp share price drop. One investor who chased the yield saw their principal investment decline by 74%, and their annual income from that stock dropped by 74% as well. As a student, you cannot afford that kind of loss. Most trustworthy dividend stocks yield no more than 5 or 6%. If you see something yielding 10 or 12%, run. Con number 4, taxes and fees eat your returns. Depending on where you live, dividends may be taxable. For basic rate taxpayers, there's often a dividend allowance, but even tax-free dividends count toward your total income for student loan purposes. Brokerage commissions and fees can also reduce your returns, especially if you're making small investments. Some brokers charge fees per trade, which can eat up a significant percentage of your small student investments. Here's the real answer. Dividend investing is worth it for students if you're investing for the long-term 10 years or more. If you're using a dividend reinvestment plan to automatically compound. If you're focusing on dividend growth, not high yield. If you're diversified using ETFs like SCHD or VG rather than picking single stocks. And if you have an emergency fund, first dividends are not your safety net. Dividend investing is not worth it for students if you need the money in the next 5 years. If you're chasing high yields above 5 or 6%. If you haven't built an emergency fund yet. If you're investing so little that fees eat your returns. Or if you're doing it instead of paying off high-interest debt. The cold, hard truth? For most students, putting your money into a low-cost S&P 500 index fund like VO might actually be a smarter move. Index funds offer broad diversification, lower fees, and historically solid long-term returns without the headache of picking individual dividend stocks. But if you're the type of person who needs to see progress to stay motivated, dividend investing with a drip can be incredibly powerful. The psychological benefit of seeing those dividend payments roll, and even if they're small, can keep you consistent. And consistency is what actually builds wealth. All right, let's get practical. Here's your action plan if you want to start dividend investing as a student. Step 1, build your foundation first. Before you invest a single dollar, make sure you have at least $500 to $1,000 in an emergency fund. This is non-negotiable. Dividends are not guaranteed income, they're a bonus, not a safety net. Step 2, choose the right account. Open a brokerage account with zero commission trades. Many platforms now offer fractional shares, which means you can buy expensive stocks with as little as $5. Look for brokers that offer automatic dividend reinvestment plans. Step 3, start with ETFs, not individual stocks. Instead of picking individual companies, start with a dividend ETF like SCHD or VIG. ETFs give you instant diversification across dozens of companies, which dramatically reduces your risk. Step 4, set up automatic investing. Automate a small monthly amount, even $25 or $50. Consistency beats timing every single time. As one student investor put it, it's not about timing the market or making big moves. It's about building the habit of investing every chance you get, no matter the amount. Step 5, turn on drip and forget about it. Enable automatic dividend reinvestment. Every time you receive a dividend, it automatically buys more shares. This is how the compounding snowball starts rolling. Step 6. Focus on dividend growth, not high yield. Look for companies or ETFs that consistently increase their dividends over time, not ones that pay a huge yield today. Companies that grow their dividends year after year are often the most profitable, cash-rich businesses on the planet. So here's the bottom line. Dividend investing as a student can be worth it, but only if you do it the right way. Focus on the long game. Start small. Reinvest everything. And never, ever chase high yields. The best time to start investing was yesterday. The second best time is today. Even if all you can afford is $10 a month, that $10 is building a habit that will serve you for the rest of your life. If this video helped you understand dividend investing a little better, hit that like button. It really helps the channel. And if you haven't already, subscribe and turn on notifications so you don't miss next week's blueprint. Remember, we don't judge your spending. We just optimize it. We turn scarcity into strategy weekly. I'll see you in the next one. Until then, keep building your blueprint.